Hey everyone, and welcome to this explainer. Today, we're diving into a really fascinating breakdown of the stock market as of May 2026. Now, if you've just been skimming financial headlines or quickly glancing at your portfolio app, you might honestly think everything is sunshine and rainbows on Wall Street right now. But today, we're going to uncover what is actually happening beneath the surface. Because the reality is much more complex, incredibly selective, and frankly, a whole lot more interesting than those headline numbers would have you believe. Let's start right off the bat with that big, flashy headline number. As of May 8, 2026, the S&P 500 is sitting right near record territory, with a year-to-date return of approximately 7.6%. On paper, that looks like a fantastic, healthy market, right? You'd naturally think an index up this much means companies across the board are just thriving, the economy is firing on all cylinders, and investors are confidently throwing money into pretty much every industry. But that brings us to the million-dollar question. And really, the whole premise of our explainer today. If the market is up nearly 8%, why is it so incredibly narrow? Why does it just not feel like a broad, easy risk-on market for so many investors out there? Well, the truth is that 7.6% figure is basically acting like a mirage. It's completely masking a serious breadth problem. The index is actually being carried by a very small, exclusive group of macro-favored and earnings-resilient sectors, while totally leaving much of the broader economy in the dust. Okay, let's dive into this. Here's our roadmap for decoding this uneven landscape. We'll start with the stock market illusion, then define the 2026 market barbell, look at the big year-to-date winners, check out the red flags hiding under the hood, and wrap up with your 2026 investment playbook. All right, Section 1. The stock market illusion. We really need to peel back the curtain on that 7.6% index game to see the somewhat harsh reality hiding right behind it. Now, what's really interesting about this slide is the undeniable proof of the massive disparity happening right now. Look at this ranking of all 11 sectors. Right up at the very top, you have energy up a staggering 25.9%. That is beating the S&P 500 by over 18 points. And right below it, information technology is up a super powerful 18%. But cast your eyes all the way to the bottom. Foundational, bedrock sectors like financials and healthcare are actually losing money for the year, down 5.4% and 6.1%. Think about that for a second. In a market up nearly 8% overall, healthcare and bank stocks are literally in the red. This just proves we are in a highly selective environment where leadership is heavily concentrated. Moving on to Section 2, the 2026 market barbell. To really grasp what's driving this massive spread, we have to understand the defining mental model for this market.
We are currently operating in what's known as a barbell market. Picture a literal weightlifting barbell in your head. Our current market is perfectly split between two very concentrated, totally opposing forces. On one side of the barbell, you have investors piling into inflation beneficiaries. We're talking sectors like energy and materials that just ride the wave of high prices, nominal growth, and geopolitical risk. Then, on the exact opposite side, you have high-quality growth. Investors buying up technology because of its incredible earnings resilience, even with massive macroeconomic headwinds. The entire market is essentially being propped up by these two heavy forces at the far ends, with very little holding up the middle.
So let's look at Section 3, the big YTD winners. We need to take a closer look at those specific heavyweights sitting on either end of that barbell. Comparing our two top sectors shows a really stark contrast. Over on the energy side, this is our absolute tactical leader. Its massive 25.9% surge is heavily fueled by geopolitical risk, the supply risk premium in the Strait of Hormuz, Brent crude hovering near the $100 mark. It's basically the cleanest expression of our current macro environment and the ultimate inflation hedge. But then you look at technology, our structural leader, up 18%. Now, normally, high interest rates absolutely crush long-duration tech stocks because their future earnings get heavily discounted. But not this year. Actually, scratch that. Tech is completely absorbing that rate pressure purely through the incredible structural durability of AI infrastructure demand, semiconductor leadership, and mega-cap profit margins. So just remember, energy is an event-driven tactical play, while tech is the strongest secular growth engine we have going. But hey, the winners aren't just pure tech and pure energy. Notice how industrials and materials are also winning big, up 12.5% and 13.8%. They're acting as these fascinating hybrid quality cyclicals. They're benefiting massively from the actual physical build-out of this new economy. We're talking major infrastructure spending, defense, and the staggering capital expenditures needed to build out AI power grids.
To put that into perspective, a single AI query requires nearly 10 times the electricity of a standard Google search. These sectors offer this perfect blend of cyclicality and structural support, so you get inflation sensitivity and infrastructure demand without needing a perfectly healthy everyday consumer. Let's move to Section 4 and see how this builds, because it's time to flip the script. We really need to examine the glaring warning signs coming from the lagging sectors. The irony of this current market is honestly staggering. In an environment where the main index is up over 7%, the very foundation of our economy is cracking. Financials, down 5.4%. Healthcare, which is traditionally your defensive stronghold, down 6.1%. And consumer discretionary is practically flat, barely scraping by with a 0.6% gain. Listen, when credit-sensitive banks and everyday consumer sectors are struggling this much, that is a massive red flag. A durable, broad bull market usually requires healthy banks and confident consumers to participate, and right now, they simply aren't.
So why exactly is this happening? Well, the pressures on these laggards are immense and highly structural. While AI is making tech companies incredibly wealthy, everyday consumers and banks are getting squeezed tightly. They're dealing with elevated borrowing costs and sticky inflation. High gas prices stemming directly from that expensive crude oil we just talked about act like a literal tax on lower and middle-income households, which completely crushes consumer discretionary spending. Add in tighter credit conditions and an uncertain yield curve squeezing bank profit margins, and yeah, you can totally see why investors are actively avoiding sectors that desperately need lower interest rates or a strong consumer to thrive.
All right, Section 5, your 2026 investment playbook. Let's bring all this data home and translate it into some strategic takeaways.
Here are your clear, actionable rules for navigating this crazy, uneven landscape. Step 1, stay with what is working. That means tactical energy and structural tech, but know the difference between them. Energy can lose momentum super quickly if oil stabilizes, while tech has a much stronger multi-year foundation. Step 2, do not chase the weak sectors without confirmation. Just because financials or healthcare are down doesn't automatically mean they're a bargain right now. Step 3, use industrials as your best non-tech compounder to take advantage of that sticky infrastructure and defense spending. And step 4, keep staples and utilities in your portfolio as defensive ballast. They aren't going to give you aggressive upside, but they will stabilize your portfolio if geopolitical risks get worse.
So the absolutely crucial point here is this. Wait for confirmation signals. Before you try to be a hero and rotate your money into struggling sectors like financials or consumer discretionary, you need concrete evidence of economic repair. What does that look like? Well, we need to see lower treasury yields. We need to see stabilizing crude oil prices to take that tax off the consumer. And we need to see better market breadth, where more sectors are actively contributing to the index's growth. Until those macro factors actually shift, avoiding those vulnerable sectors remains the smartest play by far.
And that brings us to the end of our analysis. As we wrap up this explainer, I want to leave you with one final pretty provocative question to consider about your own investments. Are you properly positioned for the 2026 barbell? Are you unknowingly holding the heavy weight of those lagging sectors? Take a really hard look at your portfolio today. Does it reflect the reality of sticky inflation and AI dominance? Or are you just waiting for a broad market rally that simply hasn't arrived yet? Thank you so much for joining me on this explainer. Keep analyzing, keep questioning, and above all, keep learning. Catch you next time.